Right now, tech giants are building these artificial intelligence data centers, and they are so massive that they require basically the equivalent of multiple commercial nuclear reactors just to keep the servers from going dark.
Yeah, it is a completely unprecedented shock to the global energy grid.
Right, and the historically predictable, slow-moving utility companies are the ones actually holding the keys to that power.
Which is a wild position for them to be in.
It really is.
Yeah.
So welcome to a brand new deep dive. Today, we are cracking open the official transcript of Duke Energy Corporation's second quarter 2026 earnings conference call.
Featuring CEO Harry Sedaris and CFO Brian Savoy.
Exactly. And, if you are a retail investor tracking where the physical infrastructure of this whole AI revolution is actually being built, the numbers buried in this call tell the entire story.
Oh, absolutely.
We have this massive, $1 billion a month construction spree, a high-stakes standoff over who actually pays for new nuclear development, and, a really delicate political balancing act.
Right, trying to keep basic electricity affordable for you, the everyday consumer, while spending all this capital.
Right. And as always on this show, we want to look at this from an actionable, data-forward perspective. We are translating the Wall Street jargon into plain language to see if this is a strong signal for investors.
Yeah, because the tension in this transcript is just palpable. Duke is basically caught between two completely different eras of energy generation.
How so?
Well, they are operating this legacy grid infrastructure, right? But simultaneously, they're trying to finance the future of global technology.
It's like having one foot in the past and one in the sci-fi future.
Exactly. And when you look at their headline numbers for this quarter, you see the friction of that transition immediately.
Right. Let's hit those headline numbers.
So Duke reported adjusted earnings per share, or EPS, of $1.43. That is a massive leap from the $1.25 they reported in the same quarter last year.
$1.43 versus $1.25. That is a huge beat.
It is, and management attributed this entirely to the infrastructure investments they are making to serve their rapidly growing jurisdictions. Plus, just general customer growth in their electric utilities.
But building the physical backbone for an AI-driven economy requires putting massive amounts of steel in the ground.
Oh, yeah.
And that creates immense drag on the balance sheet, doesn't it?
It really does. In fact, CFO Brian Savoy specifically called out the two major headwinds that are chewing into those higher earnings.
Which are?
Higher depreciation expense and higher interest expense.
Right. Let's translate that for everyone listening. If you are building billion-dollar generation facilities and stringing high-voltage transmission lines across the Carolinas, you are taking on massive debt. Especially
in a historically unforgiving interest rate environment like we have now.
Exactly. So the asset depreciates from the moment it comes online, which hits your income statement. And meanwhile, the interest payments on all that debt just bleeds your cash flow.
Yeah, it's like buying a brand new, wildly expensive car on a high-interest loan. The car loses value the second you drive it off the lot. That's depreciation. And the monthly loan payment eats up your paycheck.
That is a perfect way to look at it. But they also had some help from other segments, right?
Yeah, Savoy noted that their other segment was up 3 cents. That was driven by lower interest expenses from the proceeds of their recent Tennessee and Florida transactions.
Ah, so they sold off some assets.
Right, plus some higher market returns. And their gas utilities segment was largely flat year over year. Management brushed that off as standard performance for what they call a shoulder quarter.
A shoulder quarter meaning like spring or fall where people aren't running heaters or AC as much.
Exactly. The flat gas growth there is completely typical, but the way they are managing their balance sheet friction is where the real operational strategy emerges.
Selling off assets to pay down debt, you mean?
Right. Using asset sales in non-core markets, like those Tennessee and Florida transactions, to suppress that rising interest expense.
This is a protective maneuver.
Totally. They know the capital expenditure required over the next 5 years is going to be astronomical. So they are aggressively pruning the portfolio today to ensure their credit profile can withstand the borrowing they're going to have to do tomorrow.
Okay, I want to challenge the narrative here for a second. Because management leaned heavily into the weather factor for their strong mid-year performance.
They definitely did.
Savoy explicitly detailed a colder than normal first quarter that slammed right into a very hot second quarter. If you live in these territories, you definitely felt it.
Oh, for sure. Extreme swings.
Right. So to me, the financial success they're touting seems highly dependent on just a lucky break from Mother Nature.
I see where you're going with this.
If you have extreme temperature swings forcing millions of customers to blast their heaters in March and then their AC units in June, the cash is going to roll in regardless of how smart the executive strategy is.
That's a fair point.
So how much of this $1.43 EPS is sustainable operational excellence, and how much is just the sheer luck of a heat wave?
Well, as an investor, you always have to strip out weather variations to find the true structural health of a utility. And analysts, they model for that exact volatility.
Right.
But the transcript reveals that management is not simply pocketing this weather windfall as unearned profit.
What are they doing with it?
Savoy detailed a strategy of what he calls O&M agility for the back half of the year. Operations and maintenance.
Okay, O&M agility. Translate that.
Basically, when extreme weather generates a sudden influx of revenue, Duke funnels those excess profits directly back into their generating facilities.
So they don't just let it flow to the bottom line.
Exactly. They use the cash to accelerate maintenance schedules, replace aging components, and harden the grid.
I see. Because if they let the weather artificially inflate their annual earnings, it just sets an impossible benchmark for the following year, right?
Precisely. The market would expect them to hit those same high numbers next year, which they couldn't do without another freak heat wave, so they absorbed the cash into the physical plant instead.
They were essentially using the hot summer to prepay their maintenance bills for the winter.
Yeah, they are bulletproofing the assets. By pulling maintenance spending forward into a highly profitable quarter, they ensure those plants run at maximum efficiency when the next demand spike hits.
That actually makes a lot of sense from a risk management perspective.
It gives them tremendous financial flexibility, too. Think about it. If 2027 turns out to be incredibly mild and revenues dip, they have already completed their major preventative maintenance.
Oh, wow. So they can dial back their O&M spending next year to protect their margins if they need to.
Exactly. It is a brilliant mechanism for smoothing out earnings volatility while keeping the physical grid heavily modernized.
And they're going to need every single ounce of that grid modernization because the demand they are bracing for goes way beyond seasonal weather spikes.
Yeah, the weather is nothing compared to what's coming.
Right. This earnings call laid out the stark reality of the data center boom. Let's look at the numbers. Duke has already locked in 7.8 gigawatts of electric service agreements, or ESAs, exclusively with data center customers.
That alone is massive.
But sitting right behind that is a staggering 15.4 gigawatt pipeline of late-stage negotiations, and they expect to convert those to ESAs by the first half of 2027.
Yeah, a 15.4 gigawatt pipeline is honestly difficult to comprehend.
Give us some context. What does that actually look like?
We are talking about the equivalent output of perhaps 15 large-scale commercial nuclear reactors.
15 nuclear reactors.
Yes, dedicated entirely to commercial and industrial demand, heavily concentrated in Florida, Indiana, and the Carolinas.
That is just wild.
And Savoy noted that these hyperscale customers, your Googles, Microsofts, Amazons, they're not just kicking the tires. Many have already moved to vertical construction.
So the buildings are actually going up right now.
Right. They are expected to start drawing massive loads from the grid as early as the second half of 2027. And that demand is just going to accelerate aggressively into the early 2030s.
This is an industrial mobilization unlike anything the sector has seen in, 50 years?
At least, it's historic.
But here's the thing. CEO Harry Sedaris was very quick to introduce their Customer Protection Plus commitment.
Yes, that was a big talking point.
He noted it aligns with a ratepayer protection pledge they signed alongside these tech giants. He insisted that the contracts are structured so that these massive tech users pay the costs of the specific infrastructure required to serve their facilities.
Right. They want to assure everyday customers that they won't foot the bill.
But let's strip the corporate branding off this and look at the mechanics. And let me use an analogy here.
Go for it.
If a tech billionaire builds a 50-bedroom mega mansion at the end of a quiet suburban street, that house is going to need a massive dedicated water main installed just to service its swimming pools. Now, the mansion owner should pay for that pipe, not the existing residents in the small houses on the street.
Naturally.
Duke claims they are protecting residential customers from rate spikes. But how do they legally guarantee that everyday ratepayers won't end up subsidizing big tech's private infrastructure?
Okay, so the mechanism they are relying on is called a minimum take provision, and it's embedded in every single one of these electric service agreements.
Minimum take provision, how does that work?
Well, Duke is not building a multi-billion-dollar substation and transmission corridor on the mere hope that a data center operates for 20 years.
Right. That would be insane.
Exactly. So they forced the tech company to sign a legally binding contract, obligating them to purchase a massive predetermined volume of power for a decade or more.
So no matter what happens, they have to pay for that power.
Even if the tech company goes bankrupt, or if, say, AI algorithms become hyper-efficient and power demand drops, or even if the data center simply relocates, the tech company is still legally required to pay for the power they promised to buy.
Oh, wow.
Yeah. The minimum take provision shifts the catastrophic risk of a stranded asset entirely onto the balance sheet of the hyperscaler.
The tech companies are effectively forced to underwrite the utilities' capital expenditures before a single shovel even hits the dirt.
Exactly.
But Sedaris went a step further on the call. He claimed that integrating these data centers will actually eventually deliver billions of dollars in benefits to existing customers.
Yeah, that claim sounds a bit too good to be true at first glance.
Right. Like, how does building stuff for Google lower my power bill?
It rests on the physics of grid utilization and the economics of fixed overhead.
Break that down for us.
Think about all the massive fixed costs a utility has. Legacy transmission networks, corporate overhead, billing infrastructure, pension liabilities for their workers.
Huge recurring bills that just exist no matter what.
Right. And currently, those fixed costs are divided across their existing ratepayer base, you and me.
Wait.
But when you integrate a 15 gigawatt customer base, a base that has already paid for its own dedicated infrastructure through those minimum take provisions, that new customer is now feeding massive, massive volume into the general revenue pool.
Ah, I see.
So the utility's baseline fixed costs are suddenly spread across a vastly larger volume of electricity sold.
So the sheer mass of the data center demand dilutes the overhead burden for everyone else on the grid.
Over a long enough timeline, yes. Once the initial capital investments for the data centers depreciate, the revenues generated by selling unprecedented volumes of power to Microsoft, Amazon, or Google systematically lower the per unit cost of electricity across the entire system.
It is a pure economy of scale.
Exactly. But, and this is a huge but, it relies on Duke actually being able to construct the infrastructure without crippling supply chain failures.
Which brings us to Section 3. The logistics of this build-out are just staggering. Duke is currently deploying more than $1 billion every single month.
$1 billion a month, let that sink in.
Management calls it the industry's largest regulated capital plan. And during the Q&A, analyst Nick Campanella from Barclays zeroed in on this. He was asking about their capacity for even more spending.
Yeah, that was a very telling exchange.
Savoy casually confirmed that there is a $5 billion to $10 billion upside to their current 5-year capital plan, just to support additional generation and transmission before the end of the decade, specifically calling out Florida and Indiana.
So they might spend up to $10 billion more than they already plan.
Exactly. And to meet this immediate surge, they are defaulting to natural gas.
Right, because gas is dispatchable and relatively quick to build.
Yep. They currently have 5 gigawatts of gas generation under construction, another 2.5 gigawatts advancing in development, and they recently signed a massive framework agreement with GE Vernova to secure up to 26 new gas turbines.
That GE Vernova framework is such a critical risk mitigation strategy for them.
Why is that?
Because every major utility globally is looking at the exact same AI demand curves, and they are all scrambling to secure heavy gas turbines. It's a bottleneck.
A massive one. If Duke buys on the spot market, they are competing with the rest of the world for very limited manufacturing slots.
Right, you can't just order a gas turbine on Amazon Prime.
No, you definitely can't. So by locking in a framework for 26 turbines, they secure priority access to the heavy manufacturing supply chain. It allows them to dictate the pace of their own expansion, rather than waiting in line behind competing utilities.
Okay, that makes sense. But securing the turbine is really only half the battle. They still have to physically build the plants, pour the concrete, string the lines, and commission the facilities without blowing past their budgets.
Which is incredibly hard to do right now.
Right. With every utility in the country competing for the same raw materials, specialized labor, and engineering firms, how does a regulated entity deploy $1 billion a month without getting choked by bottlenecks?
Sedaris actually addressed this on the call by detailing their shift to highly programmatic building strategies.
Programmatic building.
Yes, they are completely abandoning the concept of bespoke engineering, meaning custom-designed power plants.
Exactly. Historically, A utility might design a power plant uniquely tailored to the specific topography, geology, and local regulations of a given site.
Right.
Duke is moving to identical standardized site designs. Every new gas plant uses the exact same blueprints, the exact same valving systems, the exact same GE Vernova turbines.
They are essentially treating multi-billion-dollar power plants like franchise restaurants.
That's a great way to put it.
You design it once and stamp it out 10 times.
It creates enormous synergies, particularly with specialized labor. Sedaris noted they are utilizing single EPC engineering, procurement, and construction partners in regions like the Carolinas.
So they use the exact same construction companies too.
Right. When a team of specialized welders finishes a standardized module at a plant in North Carolina, they do not have to learn a completely new schematic for their next job.
They just pack up and go to the next site.
Exactly. They move directly to the next site and execute the exact same welds on the exact same equipment.
That has to save an incredible amount of time.
It does. Furthermore, they are deploying AI tools to monitor construction milestones in real time.
Oh, using AI to build the power plants that will power the AI. That's very meta.
It is. But it works. If a specific component is delayed in shipping, the AI reroutes the construction sequence to keep crews active on other parts of the site. It prevents those costly labor stand-downs where guys are just standing around waiting for a part.
That is smart execution.
Yeah.
But analyst Carly Davenport from Goldman Sachs brought up what I think is the most obvious vulnerability in this massive gas strategy.
The fuel supply.
Exactly. If you are securing 26 new gas turbines, you have to guarantee the natural gas supply to actually fire them. A turbine without fuel is just a multi-million-dollar stranded asset.
Yeah, a very expensive paperweight.
Sedaris stated their advanced planning team has already secured all the necessary natural gas supply through the early 2030s.
Which is crucial.
It is. Gas is clearly their immediate bridge. It's the dispatchable fuel they know they can deploy rapidly to meet those 2027 data center deadlines.
Right, they don't really have another choice for the near term.
But gas cannot be the end game. Not if they are going to hit their long-term emission targets while feeding 247 baseload power to the tech industry.
No, it definitely can't.
And that brings us to the nuclear question. This is a topic where Duke's management sounds incredibly cautious on the call. Honestly, almost paranoid.
Paranoid is the right word, but you have to remember, they are managing the largest regulated nuclear fleet in the country. Their first priority is entirely defensive.
Defending what they already have, you mean?
Exactly. Protecting and maximizing the assets they already own. Sedaris outlined their strategy to extend the operating lives of their existing nuclear units to an unprecedented 80 years.
80 years. Pushing a nuclear facility to an 80-year lifespan requires massive regulatory navigation.
Oh, the paperwork alone is staggering.
But they already have subsequent license renewals approved by the Nuclear Regulatory Commission for 2 of their plants. And they are prepping a 3rd application for the Brunswick facility by the end of this year.
Right. And alongside the life extensions, they are executing 300 megawatts of uprates on their current units.
Okay, let's stop and define that for our listeners. What exactly is an uprate?
An uprate is simply the most economically efficient megawatt a utility can generate.
How so?
Instead of navigating the decade-long nightmare of permitting and building a completely new facility, they just upgrade the old one. They install higher capacity pumps, upgrade the heat exchangers, and optimize the thermal output of the existing reactor core.
So they're just squeezing more juice out of the same orange?
Exactly. You are extracting 300 new megawatts of zero carbon power from a footprint that has already cleared every regulatory hurdle and, importantly, has been depreciating on your books for decades.
That is a phenomenal return on investment.
It really is.
But uprates will not solve a 15-gigawatt deficit. They just won't.
No, not even close.
So analyst Steve Fleischman from Wolf Research pressed Sedaris on their roadmap for new nuclear construction. He specifically asked if they're leaning toward large-scale AP1000 reactors or the newer small modular reactors, the SMRs.
Yeah, this is a massive debate in the energy sector right now.
Sedaris confirmed they are running dual tracks. They filed an early site application for SMRs at their Belews Creek facility in North Carolina. And they hold an existing license at their Lee facility for 2 AP1000s.
Right. The reading between the lines, the AP1000 is clearly the front runner.
Why do you say that?
Simply due to the sheer mathematics of the demand shock. Look, an SMR might generate around 300 megawatts, whereas a single AP1000 generates over a gigawatt.
Oh, that's a huge difference.
Yeah. When you are staring down a 15-gigawatt pipeline, stringing together 50 experimental SMRs introduces an unacceptable level of integration risk. It's much safer to build a handful of massive, proven AP1000s.
Makes total sense. But then Sedaris delivered what I view as the absolute most critical ultimatum of the entire earnings call.
The financing ultimatum.
Yes, he stated definitively that Duke Energy will not propose a new nuclear project without explicit financial risk protections for both their customers and their investors.
He was very firm on that.
He specifically demanded that any new structure must mitigate first-of-a-kind and supply chain risks and guarantee a strong balance sheet throughout the entire construction cycle.
Which is a tall order in nuclear construction.
It is. So let me ask you this. If a company that operates the largest nuclear fleet in the Carolinas outright refuses to accept the financial risk of building a new reactor, who is going to build them?
To understand Sedaris' ultimatum, you really have to look at the shadow hanging over the entire U.S. utility sector right now, and that is the Vogtle nuclear plant in Georgia.
Ah, Vogtle. The cautionary tale.
Exactly. It was the first new nuclear construction in America in decades. And it suffered from catastrophic cost overruns and years of schedule delays. It severely damaged the balance sheets of the partners involved.
This was a financial bloodbath.
It was. And Duke's management watched that unfold right next door. So they are drawing a hard line in the sand. They are telling Wall Street point blank that they will not risk the company's credit rating on the unpredictable supply chain of heavy nuclear construction.
So it becomes a massive game of financial chicken.
Pretty much.
If Duke won't hold the bag for construction delays, are they expecting the federal government or the hyperscalers to effectively co-sign the mortgage before they break ground?
That is exactly what is happening behind closed doors right now.
Really?
Yeah. When Julian Dumoulin-Smith from Jefferies asked about a timeline for a commercial outcome on new nuclear, Sedaris refused to commit to a date.
Right, he deflected.
But he explicitly stated they are deep in negotiations with the Department of Energy, state officials, and the hyperscalers themselves.
The ultimate standoff.
Look at the incentives. The tech industry demands clean, 247 baseload power to run their AI models. The federal government considers AI dominance a matter of strict national security, which requires domestic nuclear capacity.
And Duke is just sitting there holding the cards.
Duke is perfectly positioned. They hold the land, they hold the licenses, and they have the operational expertise. They are simply waiting.
Waiting for what?
Until the tech giants, via massive forward purchase agreements, or the taxpayers via DOE backstops, agree to absorb 100% of the cost overrun risk. Until that financial structure is legally binding, Duke will not put a single shovel in the ground for a new reactor.
Wow. That is taking a very strong negotiating stance.
They can afford to.
Which means all of this, the $1 billion a month in capital expenditures, the massive gas build-out, the negotiations with big tech, it all has to survive contact with state utility commissions.
And that's where things get really sticky.
Ultimately, Duke cannot spend a single dollar without regulatory approval, which thrusts them into a highly volatile political environment centered on one issue.
Everyday customer affordability.
Exactly. And we saw a very stark contrast on this call between how things are playing out in North Carolina versus Indiana. Let's start with North Carolina.
Right. So in North Carolina, they successfully navigated their DEC rate case.
Meaning they got the regulators to agree on what they can charge.
Basically, they reached a comprehensive settlement that establishes a 9.8% return on equity, or ROE. The capital structure was set at 53% equity, and they secured an earnings sharing mechanism up to 10.3%.
Okay, let's pause and translate this for our retail investors. A 9.8% ROE is a highly specific, aggressively negotiated number.
It is the allowed profit margin, essentially.
Right. And in the current interest rate environment, where risk-free treasury yields are sitting significantly higher than they were 5 years ago, utility investors demand a higher premium to park their capital in regulated equities.
Exactly. They need a reason to buy Duke stock instead of just buying a government bond.
Now, the 53% equity layer means Duke is financing the grid heavily with shareholder capital, rather than leaning entirely on debt. But the 10.3% earnings sharing mechanism is the fascinating regulatory tool here.
Explain how that works.
Basically, if Duke manages to streamline their operations, deploy those AI logistics we talked about, and run the grid so efficiently that their returns exceed the allowed 9.8%, the regulators do not simply confiscate every extra dollar.
Oh, interesting.
Duke is allowed to capture a portion of that excess profit up to 10.3%. It perfectly aligns the interests of the shareholders with the operational efficiency demanded by the ratepayers.
It creates a structural incentive for Duke to be ruthlessly efficient.
Exactly. But as you noted, the political climate in Indiana is vastly different. Analysts from Wells Fargo and Jefferies really pressed management on the rising tension in that state.
Yeah, they did. The governor and the state commission are heavily scrutinizing the utility right now.
Because of the broader macroeconomic pressures squeezing the middle class, escaping rent, healthcare, gasoline prices, Indiana residents are just tacked out.
And right in the middle of that, Duke is sitting before the commission preparing to justify massive capital investments to support the state's economic expansion.
Right. How does Sedaris look an Indiana utility commissioner in the eye and defend a $1 billion a month corporate spending spree when the local manufacturing worker can barely afford their grocery bill?
It's a brutal conversation to have. Empathy only goes so far in a rate hearing.
Exactly. They have to present mechanical financial solutions to suppress the immediate rate impact.
And that is exactly where Duke deploys some incredibly aggressive financial engineering.
What did they do?
Sedaris highlighted a maneuver they executed in Florida involving a major battery storage project.
Okay.
Typically, when a utility earns federal tax credits for deploying clean energy infrastructure, the accounting rules dictate that those credits are amortized, meaning they're flowed back to the ratepayer incrementally over the 20 or 30-year lifespan of the asset.
You get a little bit of the tax credit on your bill every month for decades.
Right, but Duke went to the regulators and negotiated an accelerated flowback.
So they took decades worth of federal tax subsidies and dumped them entirely onto the customer's bill in a highly concentrated window.
Precisely. They did it specifically to offset a scheduled base rate increase in 2027.
Wow.
They are using the federal tax code as a blunt instrument to artificially suppress the rate hike.
So the consumer completely avoids the immediate sticker shock of the infrastructure build-out because the tax credits absorb the blow.
Exactly. Sedaris also noted they submitted applications to the Department of Energy's loan programs, seeking access to billions of dollars in subsidized federal capital.
Which is much cheaper than corporate debt.
Very much so. By borrowing from the DOE at rates significantly lower than the commercial bond market, they drastically reduce their interest expense.
And lower interest expense means a lower revenue requirement that they have to extract from the ratepayer.
Bingo.
So they are essentially stacking federal tax credits and subsidized government debt like sandbags, just trying to hold back the floodwaters of their own capital expenditure program.
It is a masterful manipulation of the regulatory framework. It keeps state politicians placated while the company builds the assets it needs to secure its long-term future.
Which is a perfect segue into their forward guidance.
Oh.
Because ultimately, this dictates the long-term value for the institutional and retail shareholders tracking this massive transition.
Right. Let's look at what management is projecting.
They reaffirmed their 2026 EPS guidance range of $6.55 to $6.80. But the really critical data point was their confidence in a long-term 5% to 7% growth rate.
Yeah, Sedaris explicitly stated they are highly confident in delivering in the top half of that range beginning in 2028.
The year 2028 is the absolute linchpin of their entire financial narrative, isn't it?
It really is, because as Savoy detailed earlier in the call, 2027 and 2028 are when those 15 gigawatts of data center load physically connect to the grid.
And that's when those minimum tape provisions activate.
Exactly. The hyperscalers start paying full freight and the revenue finally hits the income statement, validating the years of heavy capital expenditure.
But bridging the gap between today and 2028 requires flawless balance sheet management.
Oh, without a doubt. And Savoy detailed their credit metrics to show how they'll do it. They are specifically targeting a funds from operations, or FFO, to debt metric of 14.5% this year, with a glide path to a 15% long-term target.
Okay, FFO to debt. Let's break that down for the retail investors. This is the absolute lifeblood of a regulated utilities credit rating.
It's essentially how much cash you generate compared to your mortgage.
Right. The rating agencies, Moody's, S&P, Fitch, they monitor exactly how much raw operating cash the utility generates relative to its massive debt pile.
And if Duke is spending $1 billion a month, they're heavily reliant on the commercial paper and bond markets to fund that.
Exactly. If their FFO to debt ratio slips below the agency thresholds, their debt gets downgraded. Then their borrowing costs explode.
Which would be catastrophic.
It would. That entire delicate narrative of customer affordability collapses because those higher interest rates are passed directly to the ratepayer.
And Savoy was adamant that sitting at 14.5% provides a substantial cushion against those downgrade thresholds.
But how do they maintain that cushion without crushing their stock price by issuing tons of new shares?
Well, they have completely eschewed large block equity sales. Analyst Richard Sunderland from Truist asked about their equity needs, and Savoy revealed they have proactively priced $600 million under an at-the-market or ATM program this year.
Ah, an ATM program. That allows them to act like a stealth operator in the capital market.
Explain how that works for the listeners.
Instead of announcing a massive dilutive secondary offering, which, typically sends the stock price plummeting because everybody panics, they slowly trickle new shares into the open market on a daily basis.
Just a little bit at a time.
Exactly. They absorb equity capital at prevailing market prices without triggering volatility. They're quietly funding the down payments for this infrastructure boom without spooking their existing shareholder base.
And they are keeping the retail investors happy too. They raised their dividend by 2%, maintaining a streak of over 20 years of consecutive growth. That keeps the income-focused retail investors anchored.
But the most revealing exchange regarding Duke's long-term financial architecture actually came from Steve Fleischman at Wolfe Research.
Oh, this was the best part of the call.
He pressed Savoy on the structural complexion of Duke's cash flow, because currently a massive portion of Duke's operating cash is subsidized by the government.
Right, through those nuclear production tax credits and battery investment tax credits.
Fleischman wanted to know what happens to the balance sheet in the late 2020s and early 2030s when those federal tax credits inevitably expire.
Because if your cash flow is heavily reliant on government subsidies, the expiration of those subsidies represents a massive fiscal cliff.
Exactly. You suddenly lose a ton of free money.
But Savoy's response illuminated their entire decade-long strategy. He acknowledged that they are currently accelerating the flowback of tax credits to protect customers today, but he noted that by 2028 or 2029, they hit parity on the nuclear PTCs.
And as they move into the 2030s,
the financial engine fundamentally transformed.
The cash flow transitions from a government-subsidized model to a pure hard asset return model.
Yes.
Okay.
Exactly. By the early 2030s, the 5 gigawatts of new gas plants, the sprawling transmission corridors in Florida and Indiana, and that massive bespoke infrastructure serving the 15 gigawatt data center pipeline, it will all be fully operational.
And embedded in the rate base.
Precisely. The earnings power transitions seamlessly. Instead of harvesting federal tax credits, they will be earning regulated, systemic returns on the hundreds of billions of dollars of physical steel they are putting into the ground right now.
Wow. They are using the federal tax credits as a financial booster rocket just to survive the friction of the capital build-out.
That's a great analogy.
And then, once the infrastructure is physically deployed and integrated by 2030, the sheer gravitational mass of those hard assets takes over, generating a durable, massive cash flow engine for decades to come.
It really is a brilliantly sequenced transition of capital dependency.
It is. So let's wrap this up. When you look at the entirety of this earnings call, Duke Energy is navigating a geopolitical and technological minefield.
They absolutely are.
They're utilizing O&M agility to weaponize extreme weather profits. They are executing the largest programmatic capital build-out in the industry's history, using standard gas blueprints to bridge the gap to the 2030s.
And they are engaging in high-stakes brinkmanship with the federal government and hyperscalers over the financial risk of new nuclear generation.
Right, all while aggressively manipulating tax credit flowbacks to mask the true cost of this revolution from the everyday ratepayer.
They are completely redesigning the physical and financial architecture of the U.S. power grid in real time.
But, and here's where we want to leave you, the listener, with a final thought to mull over. All of this reliance on tech giants brings up a critical vulnerability.
What's that?
Duke is using minimum take provisions in Customer Protection Plus to force hyperscalers like Google, Microsoft, and Amazon to finance their own dedicated power infrastructure. Big tech is effectively paying to build private, highly advanced grids that sit parallel to the public system.
That's true. They are footing the bill for their own massive setups.
Right. But if you are tracking the long-term trajectory here, you have to ask yourself a question.
Okay.
If these trillion-dollar tech conglomerates become accustomed to financing, permitting, and securing their own multi-gigawatt power ecosystems, how long will it be before they realize they possess the capital and the political leverage to simply bypass the traditional utility middleman entirely?
Oh, wow. That is a fascinating point. Why rent the power from Duke if you can just build the plant yourself?
Exactly. We will leave you to ponder that exact question. Thank you for joining us on this deep dive. We will catch you on the next one.